This is Alan Bush with ADMIS with the Daily Financial Forecast for Thursday, February 25th. Just coming up from the trading floor, traders down there talking about the Chinese equity markets that have come under a little pressure today. Also lower energy prices, exerting some downside pressure on stock indices this morning, although it looks like the volume is relatively light. Some of the pressure mitigated, though, by the durable goods orders report that did come in better than expected. In fact, up 4.9%. It was better than the 2.9% guess that traders had. Longer term, though, we feel that stock indices will be well supported by the interest rate environment globally that is still very accommodative, and if anything is likely to become even more accommodative. Now, moving over to the currencies, we are seeing the dollar index advancing as interest rate differentials remain favorable to the greenback. Don't forget that the Fed is still the most hawkish of all of the major central banks, even though they have quite a bit backed away from their hawkish rhetoric in the last 6 weeks or so. Only the Bank of England also is potentially to raise interest rates, but probably not until 2018. At least that's according to financial futures markets. My analysis suggests they will not be raising rates even then. So in any event, the dollar is likely to be the best performer of all of the major currencies, best performer to the upside. Seeing the euro currency higher, even though we did have inflation numbers in the Eurozone coming in a bit on the weak side, up 0.3%, the guess was up 0.4%. This suggests that there is more of a reason for the European Central Bank at their March 10th meeting to add more stimulus. So longer term, the weak inflation numbers could be viewed as a negative for the euro currency. Even the pound able to advance a bit after yesterday, the British pound dropping to its lowest level since March of 2009. Don't forget, we do have the UK referendum on June 23rd to exit the European Union, and in advance of that referendum, it should be very difficult for the pound to sustain any type of advance. Now, moving over to the interest rate futures markets, we are seeing prices higher, even though we did have that better than expected durable goods report, which is a bearish influence. However, Treasury supported by weaker stock indices and lower oil. Longer term, we feel that the Fed will be very slow to raise interest rates. Even the financial futures markets are now calling for the Fed to raise rates as far as the probability at the December meeting of only about 42%. So fundamentals appear to be bullish on balance for the interest rate futures markets, especially at the long end of the curve, and with major central banks around the world adding more stimulus. We do believe that the long end will probably hold up well, and the trend still appears to be higher for the 30-year Treasury bonds. So good trading, everyone, and once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.